So now, how does an insurance company actually manage fixed annuities and determine the actual rate?
That's a great question. So credited rates aren't well understood how an insurance company comes up with the number that they're able to credit. So credited rates can either be a fixed interest rate or a return linked to an index. General account products are backed by fixed income securities, typically bonds. In order for the insurance company to set a credited rate, insurers need to estimate the expected yield of the investments backing the policy. So first, the insurer needs to construct a portfolio of assets that match the cash flows that were promised to the policyholder. So this is done by modeling the cash flows of a representative block of policies that the insurer expects to sell in the marketplace. You can imagine if the block of annuities were very liquid or expected to be very liquid and had no restrictions on policyholders surrendering, the modeled asset portfolio would need to provide for early cash flows. In that case, the insurer would invest in shorter duration bond portfolios, say 3 to 5 years in length. If, though, the expected business had a long surrender charge schedule, sometimes these can be 9 years or longer, the asset portfolio would invest in longer bonds, maybe 7 to 10 years in duration. The next step is that the insurer would need to get market quotes on bond yields net of expenses and discounted for expected defaults. This gives the insurer the amount of expected net revenue from their investments, and it's going to be used to pay benefits promised to policyholders. Other than collecting surrender charges from policyholders who lapse within the surrender charge period, the insurer has no other source of revenue other than earnings from the asset portfolio to pay the promised benefits. Revenue on lapses is usually referred to as surrender gain, and the surrender gain is expected to be a relatively small factor in pricing because few policyholders are likely to surrender the contract in the first few years when surrender charges are at their highest. From this revenue stream, made up of cash flows from the invested assets and surrender charges, the insurer needs to pay the costs associated with the strategy the policyholder selected. For example, a 1-year point-to-point return on the S&P 500, say, capped at 10%. This cost is referred to insurers as the options budget. And from net revenue, the insurer also needs to pay for policy expenses, including the cost of issuing a policy, which includes setting the policy up on an admin system, generating and mailing out a policy, and ongoing maintenance expenses. In addition to that, they also have to pay for other miscellaneous expenses, paying their charter fees, making sure that they do correct accounting and their financial reporting. Another expense that also has to be covered by the insurer are distribution costs, which are the costs of paying commissions to the sales rep. And finally, there's the cost of holding regulatory capital to back the benefits promised to the insurer, to the policyholder. This capital that an insurer must hold is a function of the types of assets that the insurer is holding to back the liability, the insurance company's rating, and whether the contract is out of the surrender charge period or liquid. Whatever the insurer is left with when they subtract expenses from revenue is their profit. And so it sounds complicated, but there's only two main components, revenue and expenses. It would probably help if I made a simple example to follow this through. The insurance company, say the insurance company wants to sell a fixed index annuity and creates a model asset portfolio that throws off cash flows to fund the expected obligations to the policyholder. The insurer invests in a portfolio of assets that can fund the cash flows. And one would think that the insurer would simply pick the highest yielding assets to fund that liability, so that the revenue side of the equation would allow for a higher credited rate. But unfortunately, it's not that simple. There are no free lunches in pricing. More yield comes with more risk, and therefore the expected default rate of those instruments would be higher. After netting out the higher default rate, the net yields are typically the same. If the insurer expects the average policy to be on the books for, say, 10 years, they'll match the duration of the liability to the duration of the asset. For illustration, let's say that the net yield of the asset portfolio is 4%, which is in the ballpark of where the market is today. And the insurer expects little additional revenue from early surrender gains because the surrender charges in the contract is relatively high and few surrender. Let's also assume that the insurer carves off 2.5% out of the 4% of the 4% net earn rate to pay for the credited rate strategy that the policyholder selected. The insurer expects to incur, say, admin expenses of 25 basis points, which is very customary per year, and expects to pay out a 75 basis point sales load, which is also customary. Usually it's structured as an upfront commission, but we'll level it off to 75 basis points per year. And further, they have to hold 25 basis points for regulatory capital, which is also in the ballpark. That leaves an expected profit for the insurance company of the difference between the 4% annual revenue from the bond portfolio, less the 2.5% to pay for the credited strategy through the options budget, and further 125 basis points for all the other expenses that I mentioned, admin, capital, and also sales loads. This leaves an expected net profit of about 25 basis points per year. And this expected number is based on many factors. The actual profits obviously are going to be higher or lower than that, depending on what happens on experience, but it's in the ballpark. 25 basis points is where most insurance companies think that they're going to end up with revenue minus expenses. So how could an insurance company either make more profit or credit higher rates given that equation? So as we saw, higher yielding assets won't help because they come at the expense of more risk as regulatory capital will need to be adjusted. The biggest opportunity for higher profits within that equation is to hold less regulatory capital. I recently talked with a private equity firm that plans to do just that. They have purchased a domestic insurance company, and they're setting up a captive reinsurer offshore that expects to hold a lower capital requirement. Lower capital requirements mean that 25 basis points that they have to hold is going to be a lower number, and hence they're either going to make more profit or they could credit a higher rate. Now, insurers have to be very careful that they have fully vetted out the proposed debt structure with their auditors. But if it's successful, by reducing the required capital with the same cash flows, you'll net higher ROEs, or you can credit a higher credited rate to the end policyholders. There continues to be significant interest and potential opportunities for private equity firms to explore this path, and I expect that will be a very popular strategy in the next few years as we're being squeezed on the fixed income side, and also the volatilities are higher.